Most real estate investors know that depreciation is one of the best tax benefits in the code. But the way most people take depreciation is the slowest, least efficient version possible. They spread it out over 27 and a half years. The IRS default and collect a modest deduction every year like clockwork. Hi, I'm Aradhana Aggarwal. I am a CPA and my goal is simple: to help everyday people understand taxes without fear, confusion, or jargon. In this video, I will talk about how, with cost segregation, you can take that same depreciation and compress it. Instead of waiting nearly 3 decades, you front load the deductions, pulling years or even decades worth of write offs into the first few years of ownership. In some cases, into year one. Today, I'm going to break down exactly what cost segregation is, how the IRS allows it, what the numbers actually look like in practice, who it makes sense for, and the mistakes that cost people money when they do it wrong. Let's get into it. Before we get into cost segregation specifically, let's make sure we are on the same page about depreciation itself. When you buy a piece of real estate, the IRS recognizes the building wear out over time. So they let you deduct the cost of that wear and tear as a business expense, even though you are not actually writing a check for it. It's a paper loss. For residential rental property, the IRS says that wear and tear happens over 27.5 years. For commercial property, it's 39 years. So if you buy a residential rental for $500,000, and let's say $400,000 of that is the building value, with $100,000 for land, because land does not depreciate, you divide $400,000 by 27.5 and get about $14,500 per year in depreciation every year for 27.5 years. That deduction reduces your taxable income from the property, and if you qualify under the right rules, it can reduce income beyond the property too. But the IRS assumes the entire building wears out at the same pace, and that's simply not true. And that is the opening that cost segregation exploits. Key insight: depreciation is a non-cash deduction that reduces taxable income. The IRS default spreads it over 27.5 or 39 years. Cost segregation legally accelerates it. Here is the core idea: not everything inside a building wears out on the same schedule. The structural shell, the foundation, the walls, the roof, that is going to last decades, but the carpeting, 5 to 7 years, the appliances, maybe 7 years, the landscaping, the parking lot, the outdoor lighting, 15 years, the specialty electrical systems, the cabinetry, the decorative fixtures, shorter lives too. A cost segregation study is an engineering analysis usually performed by a specialist firm that goes through your property and identifies every component that can be reclassified away from the 27.5 or 39-year schedule into a shorter recovery period. 5-year property, 7-year property, 15-year property. Once these components are reclassified, they depreciate much faster. A carpet classified as 5-year property depreciates at 20% per year under the standard method, compared to about 3.6 per year if it were lumped into that 27.5-year building schedule. That's a massive difference in how quickly you recognize the deduction. And when you add bonus depreciation on top of that, which we will get into in a moment, those reclassified components can be deducted almost entirely in the year you place the property in service. Year one. That's where the real power is. The mechanism: reclassify components from 27.5 or 39-year schedules into 5, 7, or 15-year property. Faster depreciation, larger deductions sooner. Let's make this concrete with a real example. Say you purchase a short-term rental property for $800,000. The land is worth $100,000. So your depreciable basis is $700,000. Under the IRS default, you divide that by 27.5 and get about $25,000 per year in depreciation. Over 5 years, you have deducted about $125,000. Now you commission a cost segregation study. The engineer goes through the property and identifies $200,000 worth of components that qualify for accelerated depreciation: flooring, fixtures, appliances, landscaping, specialty electricals, outdoor features. With bonus depreciation in effect, a significant portion of that $200,000 can be deducted in year one alone. Instead of $25,000 in year one, you might have $180,000 or more in depreciation deductions. On a $700,000 depreciable basis, you have recognized more than 25% of your total depreciation in a single year. The remaining depreciation continues on its normal schedule for the remaining assets. At a 37% marginal tax rate, $180,000 in additional first year deductions translate to roughly $66,000 in tax savings, real cash you keep rather than sending it to the IRS. The cost of the study itself typically runs between $5,000 and $15,000 depending on property size and complexity. The return on investment is almost always substantial. Rule of thumb: cost segregation typically makes financial sense for properties with a depreciable basis of $300,000 or more. Below that, the study cost can eat into the benefit. Cost segregation works on virtually any type of real property: residential rentals, short-term rentals, commercial buildings, office buildings, retail spaces, warehouses, hotels, medical facilities. If you own a building and you are depreciating it, you are a potential candidate. It also works on properties you have already owned for years. This is called a look-back study. If you bought a commercial building in 2018 and never did a cost segregation study, you can still do one today and catch up on all the accelerated depreciation you missed without amending your prior returns. The IRS allows you to claim the catch-up depreciation on a single tax return using a Form 3115 change in accounting method. That can be a massive one-time deduction. The one important caveat is that the passive activity rules still apply. If your rental generates non-passive losses, either because you are a real estate professional or you are using the short-term rental strategy we covered in another video, cost segregation becomes an absolute powerhouse. If your losses are passive and you cannot currently use them, cost segregation still builds up suspended losses that you will use eventually, but the immediate cash impact is lower. Best candidates are owners with material participation, real estate professionals, and commercial property owners who can use losses against ordinary income immediately. Mistakes that reduce or eliminate the benefits. Mistake 1: doing a cost segregation study when you can't use the losses. If your rental income is passive and you have no passive income to offset it, and you don't qualify under the short-term rental rules or real estate professional status, the deductions just pile up as suspended losses. That's not necessarily a disaster, but you're paying $10,000 for a study whose benefit is deferred for years. Make sure you can actually use the losses before you spend the money. Mistake 2: ignoring depreciation recapture. This one catches people off guard. When you eventually sell the property, the IRS taxes back the depreciation you claimed through a mechanism called depreciation recapture at a rate of up to 25% for real property. If you front loaded $200,000 in depreciation, you may owe recapture tax on that $200,000 when you sell. The strategy still usually wins over time, but you need to model the full picture: entry, holding period, and exit before committing. Mistake 3: using a low quality study. The IRS has specific engineering and documentation standards for cost segregation studies. A study that does not meet these standards, often from firms that offer suspiciously low prices, can be disallowed entirely on audit. Use a qualified engineering firm with a track record of IRS scrutiny. The ASCSP, the American Society of Cost Segregation Professionals, maintain a directory of credentialed practitioners. This is not the place to cut corners. Audit risk. Course segregation is a well established strategy, but only when the study meets IRS engineering standards. A poorly documented study is an open invitation for allowance. Let's talk about bonus depreciation because it's what turns course segregation from a good strategy into a great one. Under the Tax Cuts and Jobs Act, bonus depreciation allows you to immediately deduct 100% of qualifying property in the year it's placed in service rather than spreading it over the normal recovery period. That's what enables the massive year one deductions we talked about earlier. There is also a related deduction worth knowing about, the 179D energy efficient commercial building deduction. If your property qualifies, typically commercial buildings with energy efficient HVAC, lighting, or building envelope systems, you may be able to layer a 179D deduction on top of your cost segregation results for even larger write-off in year one. It's not available for residential rentals, but for commercial owners, it's worth asking your CPA about every time. And finally, when you combine cost segregation with the short-term rental strategy, you get the full effect. Massive front-loaded losses that are non-passive and can offset ordinary income from any source. That combination is why you are seeing high income professionals buying short term rentals specifically as tax shelters. It's all legal, it's all in the code, but it requires getting the structure right from day one. STR material participation plus cost segregation plus bonus depreciation is equal to non passive losses that hit ordinary income in year one legally. Here is your action plan. If you already own property, ask your CPA whether a look back cost segregation study makes sense. You may have years of missed accelerated depreciation you can claim right now. If you are acquiring a new property, commission the study in the same year you close. The earlier in your ownership, the better. Get quotes from at least 2 credentialed engineering firms, not just whoever your CPA recommends by default, and model the full picture, the upfront tax savings, the recapture at sale, and how it interacts with your overall income situation. Cost segregation is not for everyone. It requires meaningful property values, the ability to use the losses, and professional guidance to execute correctly. But for the right investor, it is one of the most powerful and completely legitimate tools in the entire tax code. The wealthy have been using it for decades, and now you know how it works too. Thanks for watching. See you next time. And don't forget to like and subscribe for more tax tips that are legal, practical, and intentional.